U.S. stocks followed up their worst week since October with their best week in over 6 months. In this week's video, we're going to go over some new details about the coronavirus, jobs numbers from last week, and also take a look in at the Semiconductor Index as it has heavy ties to the tech sector and China.
The U.S. markets had a strong response last week as the S&P 500 and the Dow Jones were both up over 3%. The Russell 2000 was up a little bit over 2.5%, and the NASDAQ led the way up over 4% just last week. And now the NASDAQ year-to-date is up over 6%, while the S&P 500 is up 3%, the Dow Jones is up about 2%. The Russell 2000 is still unfortunately negative, down about 0.7% for the year. Foreign and emerging market stocks also had a strong week as foreign stocks were up over 2% and emerging market stocks were up almost 3%. But emerging market stocks are still down over 3% year to date, while foreign stocks are down 0.7%. The chart that we're looking at today is of the Semiconductor Index, and the semiconductors are one of the market leaders last year in 2019, and is one of the sectors that we look at to determine if there's a risk-on or a risk-off environment in the market. Now, you may be wondering what exactly are semiconductors, and two examples of semiconductors are chips and microprocessors in the electronics that you use every day. Now, in the semiconductors, there's a lot of exposure to China via manufacturing and sales. And if you look at the far right of the chart, at the straight blue line, the key level on this chart is 1750, which is the breakout level from December of 2019. Now, it looks like there was a textbook backtest at the end of January with a subsequent rebound out of the semiconductors at the beginning of February, which could be a bullish signal moving forward. Now, on the flip side, if the semiconductor index falls below that breakout level around the 1750 zone, it could be due to a lower demand out of products from China due to the coronavirus fears. So that 1750 level is a very important level that we're watching on this index moving forward.
First, I wanted to give some updated information on the coronavirus. So far, we have over 40,000 confirmed cases worldwide, over 900 fatalities, 6,000 people are reported in critical condition, and 3,000 people have recovered so far. 25 countries have reported cases, but mostly are still in China. Manufacturing has also taken a large hit in China as the government has shut down many manufacturing facilities. And now, Chinese companies are warning that air shipments may be impossible for the next 3 months. Also, we had many U.S. companies on their earnings calls report that their suppliers from China cannot give them deadlines on production goals. So if suppliers from China can't meet their production goals, we could possibly see the manufacturing sector in the United States slow down. Now, to help stabilize the markets last week, the Chinese government pumped in $150 billion to their economy and their markets to help protect from the coronavirus outbreak. Also over the weekend, it's being reported that the central banks from around the world put an additional $240 billion into the markets to help shore up liquidity needs. The next story that I wanted to cover was the jobs numbers from last week that were reported for the month of January. And the jobs numbers crushed expectations yet again. The economy added 225,000 jobs in January. Now, it's important to note that the unemployment rate actually ticked up to 3.6%, but that was due to the amount of people that actually are re-entering the workforce. And we now have the largest labor participation rate since June of 2013 at 63.4%. Just another sign of a strong U.S. economy.
Fourth quarter earnings are wrapping up, and this week there's 13% of the S&P 500 companies reporting.
Thanks for watching, and please subscribe to our YouTube channel and also share our video.